Welcome to Investment Wars. I'm Joe Halpern, and this is a show about the stories we tell in markets and investing. We all love a good narrative, but we tend to build them from the data points that confirm what we already think and ignore the parts that don't. In investing, that instinct is expensive. A hot take is not a strategy, access is not the same as responsibility, and smarter investing usually starts by asking better questions. On this show, we break down big macro themes, pressure test the ideas everyone is talking about, and dig into the deeper forces shaping how markets actually work and how investors should think. Investment Wars is brought to you by Obsidian CIO. We help advisors and investors think more clearly, invest more deliberately, and build portfolios with institutional discipline, not just more product. This is episode 36, our first one back since November. Let's get into it. Private credit has been making headlines, and not always for the right reasons. Investors are asking hard questions about valuations, covenants, defaults, and whether the risks in this market are fully understood. Today, we are going to go beyond the headlines. We're going to actually open the hood, walk through how these deals work from the ground up, and then have an honest conversation about where the real risks and opportunities are. To do that, I cannot ask for a better guide. Bob Grunwald has over 30 years in middle market finance. He built a BDC from 2.5 million to 2.5 billion as president and CIO of Business Development Corp of America, one of the top performing non-traded BDCs of its time. Before that, he ran specialty finance investment banking at Nations Bank in Wachovia, took some of the biggest BDCs in the country public, and while at American Capital, he co-founded AG&C, which, if you didn't know it, is one of the largest publicly traded mortgage REITs in the country. Bob has been a lender, a banker, an M&A advisor, a private equity investor, and a fund manager. He has seen this market from every angle. Most importantly, Bob is a thought leader. So it is great to have him here as a guest. Bob, welcome to Investment Wars.
Thank you, Joe. It's a pleasure to be here, and I look forward to our conversation.
Yeah, for sure. So let's start off by really framing the space. Private credit means a lot of things. It could encompass real estate debt and all this kind of, I'll call it specialty finance stuff. But what we should focus on today, which is what I believe makes up the majority of private debt, and that is direct lending. And specifically, if I have it right, and you could correct me if I'm wrong, but direct lending is 70 to 80% of direct lending is driven by PE-sponsored companies, so private equity. Could you give us a little bit more here on just in that framework, if that's correct, and just define it a little bit better for us?
Yeah, sure. I mean, on the one hand, it's super simple. Private credit is simply the loans to businesses throughout the United States that 30 years ago were predominantly made by banks. That's what we thought our local bank would do, is when there was a local business that needed capital for expansion or they wanted to buy another business, they would go to their local bank for that financing. And that is the definition of private credit. Now, to your point, today most of private credit is created because a private equity firm is looking to buy that business, that local middle market, or in some cases larger business, predominantly based in the US. And when the private equity firm is looking to buy the business, again, they need debt financing. And while they used to go to a bank for that debt financing, they now find other sources of private credit, BDCs, interval funds, what we call non-bank sources, as a more efficient form of capital.
So I want to put a little bit more flesh on this and really help our audience visualize it. Most of this private equity, at least the first step, the first transaction in most of this is a buyout. And so let's take a family business, middle America, up at Kansas. It's been around for 70 years, and the younger generation doesn't want to take it over, or they can't take it over. And the value of that company's $300 million. Is that fair? Is that kind of in the ballpark, a reasonable kind of deal to think of?
Yeah, let me, if I can,
Yeah, go
Joe,
for
put
it.
us from Kansas to a real life deal in Texas. That was sort of one of my favorite deals that we looked at and did a few years ago. And again, one of my favorite deals because what we do in private credit is ultimately you're looking at these businesses in the US and you're like, oh wow, someone needs to do that. And you look all around your everyday life and you realize that there are all kinds of interesting businesses. So this particular business was in the business of renting the large metal plates that go over roads for road construction. So we all know those plates when we drive over them. And we have that terrible rumbling in our car. When there's road construction, you need these heavy plates to go over a hole in the road, etc. And few of us have ever thought about, well, where the heck do those metal plates come from? So in the case of this particular business, exactly as you just described, this was actually a business that was owned by a gentleman for over 20 years. And as he was getting to retire, his son wanted to buy the business from him. The problem was the son didn't have enough capital to buy the business. And so in this case, let's just use round numbers and say the business was worth about $100 million. And so the son had some capital, but he also teamed up with a private equity firm in order to buy out his father. So the entire value of the business was about $100 million. And they raised between what the son had and the private equity firm $50 million worth of equity capital.
Did you say, sorry, 50 or 15?
I'm sorry, $100 million value business.
Yeah.
And they raised $50 million worth of equity. So that's great. They've got the $50 million, but they need to get to 100. And so the next thing they did was went to their traditional bank, the bank who had lent to them for the past 30 years and said, great, we're doing this buyout of my father. You've known my father forever. You've known the business forever. Will you lend us $50 million? The problem is the bank looked around and said, well, you have this business of renting out these heavy metal slabs that if I look in the back of your yard, that they're kind of rusty old metal slabs and they're not worth a lot of money if you think about lending against inventory. And so the bank said this kind of loan just doesn't really work for us. But in our case, we looked at the business and said, oh, this business makes, let's say $10 million a year of cash flow. And so while the inventory may not have been worth a lot of money, we knew the business was worth a lot of money because it was generating $10 million of cash flow a year. And so we lent $50 million to pair with the $50 million of equity. So private equity firm and the new owner coming up with $50 million of equity, and then a non-bank doing the loan that a bank used to do and providing $50 million worth of debt secured by all of the company's assets and ultimately being a first lien senior secured loan.
So
does that make sense?
That's incredible, Bob. So when you lent that $50 million,
Yeah.
What was the rate, if you may, or just give me a range of rate that this business now had to pay a year for coverage, interest coverage?
So we did this loan a number of years ago and interest rates changed. So let me just put it in today's terms. Today that rate probably would have been what we call SOFR, which is the new form of LIBOR. So it's a floating rate base. Plus, let's say 500 basis points. And when we say 500 basis points, what we mean is plus 5%. So SOFR today is about 3%. So think of that loan as having a total yield or cost to the borrower of about 8%. That 8% is a floating rate loan, so it goes up if interest rates go up, and it goes down if interest rates were to decline.
Got you. So 8% on 50 million is $4 million a year. Maybe when you made the loan, it might have been 6%. And if it was 6%, then it would have been $3 million a year. So let's just say 3 to 4 million. And typically it's a function of EBITDA as opposed to cash flow, right? So that's earnings before interest, tax, depreciation, and amortization. And my gut is, based on this business, that the EBITDA itself was probably above 10. It's probably 15 to 20. Is that right? Or
Yeah, no, I think that's right. Again, don't want to get too technical
Yeah. Thank you.
for your clients. I used to use the word EBITDA, and then people would go, "What does EBITDA mean?" It is essentially a proxy for cash flow, but one of the very important things that we do when we underwrite a loan is not to do a simple calculation of earnings before interest and taxes and depreciation, but to say, what does this business really generate in free cash flow? And it was actually a very high cash flowing business, because once you own the plates, you don't really need to replace them. You've got them for about 30 years. And so it was a wonderfully high margin, low CapEx business.
Got you. Okay, so that's incredible, and that's a great example. Thank you. And so now, if the next day, for whatever reason, this metal slab company, and thank you for that company, it's great driving through New York City and going over all of them.
Exactly.
If they all of a sudden, for some reason, stop paying interest, the end result would eventually be that you would take the keys and private equity would get, I don't want to say wiped out, but just to keep it black and white, conceptually, you're in the driver's seat, private equity's not, you take the keys. There may be workouts and all these complexities in it, but the end result is that technically you could just take over the company. Is that correct?
Yeah, the answer is yes. And a lot of folks tend to jump right to that. Like, oh, if it's a problem loan, then you just take over the company. But the truth is, I don't know what the number is now. I've probably done $10 billion worth of loans. And I think we've taken back 2 businesses in all that time that I've done all of those loans. And the reason for that goes back to original analysis, right? The private equity firm and the owner put in $50 million into that business. So a lot has to go wrong before they're going to walk away from that $50 million. So just so we talk through this, let's say the company runs into a bump in the road. And by the way, that's maybe a good pun for this type of business. But a good example of one of the weaknesses of this business is it could be cyclical, right? So if there's a little bit less road construction, then they may see revenues and therefore cash flow decline. When that happens, we usually sit down with the private equity firm and the owner and say, hey, what can you do to cut expenses? And so they begin to make changes to reduce expenses to get cash flow back to where it should be. The next step would be, okay, this business is continuing to see tough times. Maybe you guys should put more money in it. And again, if a private equity firm has put $50 million in, they're going to often be willing to put another $10 million in to see it through maybe a 12-month or a 24-month recessionary period, because they know the business will come back when times get good again. And then in kind of the worst case scenario, they begin to see their equity value decline. So let's say it goes from 50 million down to 30 million, and they don't see a lot of hope. They think it could go to 20. Then usually they're going to try and sell the business and get some of their equity back, right? Try and salvage some of their equity before it's too late. And of course, when the business is sold, we get all of our debt back, and then maybe rather than them getting $50 million back, they get $20 million back. So that's what happens 98% of the time, is some form of either workout, more capital from the private equity investors, or ultimately the sale of the business long before the first lien lender ever takes over. So it's very rare that, as we like to say, that someone gives us the keys back. That does happen on an occasion, and if that's the case, then we take over the business, we hire outside consulting firms to help us come up with a turnaround plan, and then ultimately, within a year or two of taking it over, we usually sell it.
That's really helpful. And if you think about it, as you mentioned in the straw man, an actual straw man that you used, you have the son who really cares about the business. You have PE who has equity in it. So there's all these interested parties in making it work. And so obviously, and in summary, that first try is, hey, can we all make this work and make it work better for everyone? But ultimately, you do have that tool of saying, hey, guys, if we can't make it work, we could take it over. But it makes sense for everybody to work it out. So kind of moving, and I don't know what happened with this company, but conceptually, or technically, I guess, in the world of direct lending, I believe it's something like 20 to 30% of that PE-backed lending is due to buyout, which is the example you used. And then there's all these other initiatives that occur. So an example may be that this metal slab company sees an opportunity to put up fencing. And they know all the same people and the material's the same, and they decide, okay, we're going to go and buy a fencing company for 30 million. Is that a good example? Could you run through a few examples of where you have just more like further opportunities to provide debt to this company, and whether it's always the same, like would it be Flatrock, or is it some other firm that may jump in for that opportunity?
Yeah, so you're exactly right. So think about it. A private equity firm buys this business in Texas, and their plan really isn't to just run that same little business for forever. What they want to do is find ways to grow the business even beyond just organic growth, beyond like just increasing their customer base. So in this particular case, just sticking with the real world scenario, what happened was the son owner and the private equity firm together decided to buy an adjacent business, so another geographic market, but in this case, actually doing the same thing. So the next step for us was the opportunity to expand the $50 million loan. They bought the competitive business in an adjacent geographic territory. I don't remember exactly what the numbers were, but let's just say that other business was worth $20 million. So the private equity firm put up another $10 million of equity. We put up another $10 million of debt. As they combined those businesses, they created a lot of efficiencies, right? Because all of the owners of the other business and the chief financial officer, all of this overhead went away. And so their cash flow increased significantly. And the end of the story is that 3 years after the second buyout, they paid us off because they generated so much cash flow that they didn't need our debt anymore. So that's ultimately, the good news and bad news is our very best companies. A typical loan is 5 to 7 years of term, but our typical loan is paid off within 3 years in most cases.
That's great. And if you think about, because we're talking about both equity and credit, the private equity shop comes in, they want to create some sort of return because they're taking first loss in that they're taking that equity. They have a higher potential return because if this company just does gangbusters because all the roads in America are terrible, they, instead of making that $10 million cash a year, maybe they make 20. And they're taking all the extra that they make. And to your point, a lot of PE over the last 20, 30, 40 years is all about institutionalizing family businesses, creating efficiencies, creating scale, all these benefits that should accrue really across the board to everyone. And then what the credit piece is doing is saying, okay, you're going to pay us a fixed amount regardless. So going back to the story of like, yeah, 1 year they got to 20%, maybe in a down year, in a depression where states are hurting, maybe they only make $4 million and that all accrues to the lender. So less volatility, more control, lower return. And I think it all makes sense, right? That sounds on the surface very logical, correct? Do you have anything to add to that or did I sum?
No, I think that's exactly right. Look, private equity is a wonderful place to get, high double digit to 20% returns, but they're taking risk that if the business doesn't work out, they could be wiped out. What we're trying to do is first lien debt, where they would have to be completely wiped out before our debt would be impaired, and that's extremely unlikely, particularly when you're typically in at a 50% loan to value. So yeah, that's the key difference.
So now, the example used here, that was a direct whole loan. In other words, was it Flatrock or was it a predecessor firm that did it?
It was, we did that at my predecessor firm,
Okay,
BDCs.
so a predecessor firm went in and they took down the whole 50 million. I want to go, keep this broad and brief because it is retail, but it seems like loans can find their way into a lot of different structures. So let me ask you one more question about that. So you made a direct loan in a predecessor firm, and then was that a publicly listed vehicle, or was it a non-traded vehicle? What kind of, where I want to go here, Bob, if you don't mind, and you can just go right into it after answering the question, is how that loan either gets chopped up or not chopped up, and just give us a general view of just the different vehicles involved.
Yeah. So that particular vehicle was what we call a private BDC, or business development company. So business development companies, there were publicly traded business development companies, there were private business development companies. Let's go through all the different vehicles, although this can become feeling a little overwhelming to folks. But what everyone who is doing a private credit loan wants to do is stay highly diversified, right? You don't want to take concentration risk. So when a loan is originated, and let me use a mega firm like Blackstone as an example, okay? And often when they're originating a loan, this is not my example of a $200 million enterprise value company. This is a multi-billion-dollar buyout, right? So where are the different places that loan can go? So they'll originate a loan and they'll put a piece into their publicly traded BDC. And you can invest in their publicly traded BDC if you want. And in a moment, if you want, we can talk about the pros and cons of each of these structures. They also have a private BDC. So they'll take a little sliver of that loan, say 10% of that loan, and they'll put it into the private BDC. They also have institutional investor funds. So they've raised capital from institutional investors all around the world. They probably have dozens, if not hundreds, of those funds, and they'll put little slivers into each of those institutional funds as well. And then finally, and maybe most importantly, they will create what's called a collateralized loan obligation. And actually, of all the private credit that's done in the country, over half of those loans end up structured or put into collateralized loan obligations. And so that original loan will go some into a publicly traded BDC, some into a private BDC, some into some into institutional funds. They may also, by the way, I should mention an interval fund, because that's what we run here at Flat Rock Global. They might put it into an interval fund, and then some into a CLO. So it gets spread across a wide variety of vehicles.
And it's really interesting, and this talks to the innovation of Wall Street, which sometimes creates complexity, but the goal here is to provide an access point and exposure for different constituents in the market. You mentioned institutional insurance is really big, if I have it right, within the BDC world. Insurance is not going out and buying a BDC. They're going to have a separately managed account on behalf of that insurance, and they're holding it, and it's really important for insurance because it's going out, it's creating a yield, and they're trying to match liabilities, right? So there's all these different vehicles. Speak a little bit to, if you don't mind, just I know this is an incredibly complicated topic, but in that CLO, that collateralized loan obligation, where you said like a good 50% go, those are, who would you say those structures are positioned to? I know they're making their way into retail, but who's really consuming it? And do you believe those are pretty liquid? Does that create more liquidity in terms of the different groupings?
Yeah. So the CLOs, the beauty of the CLOs is that you end up with a highly diversified pool of loans, and they are required, because of the nature of their structure, to have an extraordinary amount of diversification and in a structure that is very highly dictated, predominantly by the rating agencies. So, for example, in general, no one loan is more than 1% of the total portfolio. So that's great. So if you invest in a CLO, you don't have to scratch your head and go, oh, what are my loan concentrations? You already know you're not going to be concentrated by loans. No one industry tends to be more than 10%, roughly, of the total. So again, we may come to it, but people are concerned about software loans today.
Yeah.
If you're looking at a private credit fund, you have to scratch your head and do your due diligence and say, hey, what kind of industry concentrations do you have? If you invest in a CLO, you really don't need to worry about that. You're diversified by industry. Okay, so you have this highly diversified pool of high quality first lien loans, and then you fund that loan by selling AAA notes all the way down to equity, okay? And the equity, think of the equity in a CLO as being just like a bank, only this is a specialized bank that only owns first lien senior secured loans. So the beauty of it is banks who used to lend money don't want to lend money anymore because it's too capital intensive. They love buying the AAA notes of CLOs. It gives them indirect exposure to loans, but it gives it to them in the form of investment grade debt. And then at Flat Global, as an example, we have funds that one fund that buys the BB rated notes of CLOs, and another fund that buys the equity of CLOs that give investors an option for different risk returns depending on what best meets their needs.
Yeah, no, that's helpful. And where we'll leave that conversation, because we're going to just move on from it because it does get complicated, is this is a way both to chop up in a way, I was scared to use chop up, but I'm going to use chop up, but it's basically aligning an exposure for different constituents. You mentioned the banks there that liked it and insurance likes it. There's a lot of a huge regulatory, I'll call it framework requirement of banks. You mentioned this makes it investment grade, and therefore it sits on their balance sheet different. And so there's all these nuances that are so important to understand, just behind the scenes of where this goes. So I want to move on from there because we could just discuss structure. We could have 2 episodes on structure, but I want to get to the industry concerns. There are 3 main concerns that I hear out there. Concern number 1, and this concern has been with us for a while, is size of market. Concern number 2 is around software due to AI. And concern number 3, which is probably the least spoken about, is and I don't even know if it's a concern, it might be a risk that's out there, is vintage. And I want to take one at a time. I want to start with size of market because you referenced it already. You referenced it twice. And both times you referenced it in that the banks moved out of this market and non-banks moved in. And I've done a lot of work on it. We had a guest on the show prior on this one because I really wanted to understand it. And that's my understanding. The banks used to make those loans, as you said. You have an actual experience where the company went to the bank and the bank said no. And the banks have moved away for a variety of reasons. We don't even have to get into it. I think that's one. The other nuance I want to bring up, if you don't mind speaking to it, if there's even a conversation here, because we could just move on to the next risk, is there's also a concern around size of market of too much asset gathering, which is another way of saying it's a size of market in that these companies raise too much money and now they need to put it to work. And that also softens covenants. Could you kind of speak to both sides of the coin on that size of market question?
Yeah, and help me out. I'll try and address your questions, but may have missed 1 or 2 in there. So let's just make sure I catch them all. Let me take a second though and just go back to structures for one moment, because when I hear your word chopped up, one of the things that my antenna goes up to is, okay, wait, are we in some type of category like we were in during the great financial crisis where we had CDOs, okay, so very different from CLOs, and we're chopping up, back then we were chopping up mortgages and putting them in lots of different vehicles with lots of leverage. Much of that leverage was marginable and callable. And in fact, we were chopping up some really bad assets, right? Subprime mortgages, et cetera, all of which imploded on us. So whenever I hear Wall Street and cutting things up, that's my great fear, and that should be every investor's great fear. So the key to remember in this conversation is how we began the conversation. So every asset that we're talking about in private credit should be a first lien senior secured loan at roughly 50% loan to value. So using the mortgage analogy, I always tell folks, imagine you buy a home and you put 50% down. The odds that you're going to default on it are low. And if you happen to default on it, the odds that the lender is going to lose money is low. So that's the asset that we're talking about. We're not talking about subprime mortgages or even mezzanine loans, that type of thing. And it's worth noting that if you looked at, let's go back to all the vehicles we talked about. If you looked at the publicly traded BDC space, while those are equities and they can move around in value, there are dozens of publicly traded BDCs that have generated excellent long-term investors, returns for investors over time. The same is true of private BDCs. And if you go to CLOs, it's stunning to see that even CLO equity has generated kind of mid-teen average returns in almost every vintage since inception. So worth noting that these structures have actually done well for investors, and I would say the short answer of why they've done well is because they start off with a very high quality asset, a first lien senior secured loan. Okay, so let's go to kind of where the market is for private credit right now. A couple things, by the way. For starters, starting last year, we saw default rates in private credit rise from what we typically think would be an average default rate of about 2% to default rates in the 5% range. Now, since then, they've come down to maybe 3% and change, but they're still above average. So a couple things to think about on that front. First of all, if you're an investor in private credit or thinking about investing in private credit, you need to recognize that this is an important asset class to be a long-term investor. So while if I could bring up a chart that shows that default rates average 2%, it's not a straight line, right? There are times when default rates, when the economy is really strong, are nearly zero. And then there are other times when the economy, particularly the recent tariff tantrum and has created issues where default rates have risen above that 2% line, and then they come back to it. And on average, we just find that over a 7-year period, they'll average about 2%. So investors should expect, though, that it's not time to run for the door just because default rates are a little bit higher than normal. And certainly that's an environment we're seeing right now. Now, to go to one of your key questions, the other issue that we've seen in the last couple of years is that as interest rates went up, you could get for a pool of first lien loans, investing in a private credit vehicle, double-digit, 10%-ish kind of returns. So very unusually high returns because these are floating rate loans. Interest rates went up, and I was able to get higher returns. So with that, there was a flood of new money into private credit. And I think in a way that was good. People should have taken advantage of that unique opportunity. But the private credit market is only so big. It's big, it's $1.5 trillion, but it's not as deep and liquid as the equity markets. And so we definitely have had, over the last 24 months, a supply-demand imbalance in which there was more demand for private credit loans than there was supply. And the result of that is twofold. One, you saw spreads or prices for loans come in, so you weren't getting as much return. But more importantly, you saw covenants, which you and I haven't talked about, but the structural protections that you have as a lender, you saw those weaken. So let's go back to our example of the steel plate company. I would have a covenant in there that said, hey, if your net income, I did the loan when cash flow was 10 million, if cash flow drops below 8 million, then you're in violation of the covenant. And in theory, I would have the right to take over the business, even with 8 million of cash flow. So that means I have leverage to then sit down with the private equity firm and say, you don't want me to take over this business right now. you need to put more cash in. So covenants are very important, and covenants have weakened. Where I've seen that kind of play out the most is where you've seen mega private credit managers that grew too quickly. So again, this is not a space where you can just wave unlimited amounts of capital in a given day or month. And I think some firms that were raising, in some cases, $1 billion worth of capital a month, quite frankly, I think, in my opinion, they had challenges putting that money to work in high quality loans with really good covenant structures that are going to give them all the protections they wanted. And that's why they ended up seeing some slightly higher losses. Let me pause there because you had a number of questions about the state of the market, but that's maybe a good way to start it.
Yeah, no, that's great. You kind of covered the size of market, product, and you also went back, and it's funny because I paused before saying chopped up. I knew it'd get a rise, and I appreciate some more definition to it. Just to be clear, first lien, as Bob said, is like that first mortgage. A second lien or pass would be taking a second mortgage on your house and you keep on going. And senior secured means you're first in line. So really helpful, Bob. We knocked off size of market. I want to touch on vintage really quickly because I think that's an interesting moment of time that we're kind of, I don't want to say we're past because I think companies are still struggling, but it's not an ongoing issue. Could you define what happened in that, I'd call it 2022 range, just to bring an appreciation to the audience?
Yeah. So in 2022, you had a vintage of loans that were originated just before interest rates went really high. So think about a private equity firm. They're doing an underwriting of this loan, and interest rates were virtually zero when they underwrite the loan. Now, they're not stupid. They maybe assumed interest rates could go up 100 or 200 basis points, or 1 or 2%. But interest rates went up a great deal more than that. And that put tremendous strain on those businesses, more strain than was anticipated when the buyout was originally done. And so those 2022 vintage loans have seen higher loss rates than other vintages, either just before it and certainly since that. Now, again, imagine now in 2023 or 24, you're underwriting you're doing a new buyout as a private equity firm. You're taking into account a much higher interest rate, and so those have been better quality loans. Now, by the way, this is a great lesson to be learned for folks investing in private credit, because what you want to do is, in my opinion, invest in private credit in a vehicle that is highly diversified by the number of loans, so no one loan is all that large, by industry. So we'll talk about software in a moment, but when someone says, oh my God, I'm worried about software, you can go, oh, well, software is not more than 10%. And diversified by vintage. So if someone says 2022 wasn't a very good vintage, what I want to do is be invested in private credit, in which that's kind of irrelevant to me because I know they've been investing for 10 years, as we have at Flat Global. And they own a wide variety of vintages. I wish they hadn't owned any 2022, but I'm diversified by vintage.
Yeah, that's helpful. And to be clear for the audience, number one, you don't know that the vintage is going to be bad until after the fact. And number two, and this is really important, is that if the vintage is bad, it gets priced in, right? And so once you know it's bad, the event's kind of over unless you didn't realize how bad it actually is. And so what you're seeing now is that got priced in or is getting priced in, and now the market may or may not be going overboard. That's a distinction that we'll figure out in the future when looking back and saying, oh, great, but that's what it is. And so that last risk worth talking about, and you touched on diversification. I've heard software upward of like 20% of this space. Is that an actual number? Is it that? Because you just mentioned like a nice 10% max for a diversified portfolio, but I heard software is kind of a big component of direct lending. Can you speak to it, Bob?
Yeah, so there are different numbers out there, but I think a good number is to say that about 25% of the private credit market is software related.
Okay.
So if you are a private credit firm and you're raising capital really fast, then you are going to have to essentially own the market, right? You're going to be like an index fund of the market, and you're going to be about 25% in software, whether you like it or not. We think being a smaller, more thoughtfully growing firm, you're able to maintain that higher level of diversification. Or if you use the CLO structures, you end up getting that diversification, which gets you down to about 10%. But let's talk about software. So it's interesting. Again, my comment to either new investors in private credit or existing investors in private credit is invest where you're highly diversified, and when the front page of the paper says we're really worried about software loans, you're like, I don't really care. It's not going to make that big of a difference because it's only 10% of my portfolio. But what is happening in software? Well, the concern, as folks know, is very suddenly Claude came out with Claude Code, and the conclusion of the market, or at least early conclusion, was that some of these software businesses could be out of business potentially very quickly. So you've seen in the equity market, software businesses sell off by 25% or more in value. By the way, it's worth noting, they haven't gone to zero, they've just gone down 25%. In the private debt markets, you've seen the value of software debt go from what we call par, so think of it as being worth 100 cents on the dollar, to being worth close to 90 cents on the dollar, so down 10%. Not insignificant. And we can sit around and debate like, how quickly will AI replace software? I really don't think that debate is one that we can come to any really definitive conclusions. But if we want to assume the market is really efficient, we can say the value of software equity is down 25% and the value of software debt is down around 10%. So let's go back to the original story of the metal plate business. If I own a software business and I did that loan at 50% loan to value, I like it better when my equity is still worth 50%. But if it was a software business and it's now down 25%, I still have equity left in that business. And by the way, that business, because it's private equity owned, isn't just sitting around waiting for its customers to be vibe coded away. They're making real-time changes to adjust to the environment. So it's definitely an issue in the marketplace. It's not irrelevant, but I think it's a great place to be in first lien senior secured debt when you've got a lot of equity behind you.
Very fair. So Bob, last question for the day here. You've been in this market through multiple cycles. What's your honest view of where private credit goes from here?
Yeah, so let me start by saying, and I should have said this at the beginning, obviously, I'm a huge fan of private credit. Why? Because in private credit, if you're an investor, you have the opportunity to pick up a significant illiquidity premium over publicly traded bonds, or let's use high yield bonds as an example, okay? 300 basis points or more, which can be very significant to a portfolio. And I do believe that one of the mistakes investors make is that they take upon themselves a massive liquidity discount in crafting their portfolios. So if you think about a typical investor, if they want their portfolio to stay completely liquid, then they are going to give up a lot of return. So private credit gives you an opportunity to pick up significant return. I think it's critical, though, that if you're going to invest in private credit, you need to recognize that I'm not going to be as liquid. So that should not be that part of your portfolio that you're looking to sell from time to time. You need to look at it as something you're going to hold for long periods of time. And then to go to the point of your question, I think over really long periods of time, you're going to get high single-digit returns from a private credit portfolio with little or no leverage. Where is the environment today? I think, as I said, I think default rates are up a little bit, but not at levels that cause great concern. I think the software situation is interesting. I think ultimately it will create more opportunities than challenges for private credit because it'll give them a chance to get higher yields on some quality loans. And I think you just need to be very careful about who you end up investing with. And the red flags I would tell people would be a firm that's gone through massive growth, which by the way may make them a big brand name. Be careful of that because massive growth does not fit very well with private credit. And then the other is to make sure that you are massively diversified. So don't let someone tell you, well, we own 25% in software loans, but let me tell you why our software loans are fine. You simply shouldn't own 25% in any one industry, as an example.
Bob, thank you for shedding light on this really interesting and growing section of the market, private credit. Appreciate your time today.
No, it's been a pleasure, Joe. Thank you.
And that's it for this episode of Investment Wars. We're not here to chase narratives, we're here to challenge them. Because better investing is not about having the loudest opinion, it's about having the clearest process. So subscribe on YouTube, Apple Podcasts, and Spotify so you don't miss an episode. And if you're a financial advisor, check out our companion show, Advisor Wars, where we tackle the business of advice, topics like alternative investing, taxes, AI, cash management, and how growth-oriented firms scale smarter. If you're an advisor interested in partnering with Obsidian CIO, or you'd like to suggest a guest, reach out at ocio@obsidiancio.com. Thank you.
Take care.
Obsidian CIO sponsors the podcast to further education and critical thinking about the factors that affect markets and investing. And the podcast does not provide investment advice. Investment advice is offered only to clients of Obsidian CIO who have entered into an advisory agreement and with whom Obsidian CIO has identified individual objectives, risk tolerance, and other investment needs.